Look, right now, half the internet is practically screaming that AI is the biggest financial bubble in human history, right? While the other half, they're insisting it's the greatest technological breakthrough since sliced bread. Everybody is obsessing over the exact same things. User growth, daily active users, revenue metrics, they are arguing endlessly about demand. But here's the thing, demand is noisy. It's driven by narratives, and honestly, demand can lie to you. $725 billion. That is the amount of real, hard cash that big tech is throwing at the AI supply side this year alone.
Welcome to The Explainer, the AI paradigm shift, bubble or breakthrough. Today, we are going to fundamentally shift how we look at this whole artificial intelligence boom. To really figure out if we're staring at a historic bubble or a lasting breakthrough, we have to stop listening to the loud, distracting arguments over consumer demand. Instead, we're going to focus on the quiet, undeniable mechanics of supply. Because while demand can be faked, you absolutely cannot fake supply. Supply requires massive upfront capital, and it tells the true story of the market.
To wrap your head around the sheer, incomprehensible scale of what we're dealing with here, imagine this. If you had started spending $1 million every single day, starting from the day Jesus was born, all the way through the fall of the Roman Empire, the Middle Ages, the Renaissance, both world wars, right up until today, you literally still would not have spent as much money as big tech is dumping into AI in just this single year. It breaks down to roughly $2 billion a day. We're talking $23,000 committed every single second.
Now, we have never seen a bubble of this magnitude for sure, but the underlying mechanics, they really aren't new. A study looking at 175 years of innovation actually found out that out of 51 major technological breakthroughs, 37 triggered massive speculative financial bubbles. And financial bubbles aren't built on bad technology. It's usually the exact opposite. Like billionaire investor George Soros points out, stock market bubbles don't grow out of thin air. They have a solid basis in reality, but that reality is distorted by a misconception. The breakthrough is totally real, but the financial expectations become completely detached from it.
Part 1. Capital Cycle Theory, a hidden framework. Okay, let's step away from the noisy metrics of the news cycle and look at a quiet strategy utilized by elite investors for over 200 years.
So what is the capital cycle theory? Well, it actually traces its roots way back to Adam Smith in the 1700s. Smith realized that money naturally flows into industries where people perceive high returns. It just makes sense. But when money flows in, competition inevitably follows. And when everyone is fighting it out in the exact same space, those high returns are naturally driven down. They get crushed for everyone. This theory completely ignores the noise of consumer demand and focuses entirely on the capital flowing through the supply side.
This framework basically builds into 4 distinct phases. First up, we have the flood. A sexy new technology appears, the returns look amazing, and capital just pours in. Next is the boom. Money keeps flooding in, competitors pile up way faster than actual demand can grow, and returns start to slip. Third is the collapse. That massive wave of new supply just crushes the returns. Prices fall, companies fail, and fortunes are completely wiped out. And finally, we reach the inheritance. Capital flees the wreckage, the original builders go bankrupt, and the smart money walks in to buy up these incredible assets for absolute pennies on the dollar. So ironically, the worst opportunities are where money is flooding in, and the best ones are where it's fleeing.
Part 2. History always rhymes, repeating patterns. Billionaire investor Howard Marks famously warns that "it's different this time" are the 4 worst words in finance. People always assume the old rules don't apply to new, world-changing tech. But let's look at the historical evidence.
The capital cycle repeats itself relentlessly. Back in the 1830s, British railways saw capital just flood in to move coal and iron faster. Parliament authorized hundreds of lines, companies overbuilt everywhere, and by 1850, the index had lost half its value. The original investors were totally wiped out, but those railways became the backbone of the British economy for the people who inherited them later. We saw the exact same thing just a decade ago with shale oil. Fracking unlocked reserves, money flooded in, drillers oversupplied the market, oil prices completely collapsed from over $100 down to $30 a barrel, and hundreds of companies practically drowned in their own supply.
But the most striking parallel for where we are right now? The 1990s fiber optic telecom boom. Telecom laws changed, and money poured into fiber optics. Carriers buried 80 million miles of cable across the country. But then, reality caught up. 85% of that fiber just sat there, completely unused in the ground. Bandwidth prices crashed by 90%. Corning, a massive fiber maker, saw its stock absolutely plummet from over $100 down to about $1.
And the crazy irony here, Corning is actually one of the hottest names in AI right now, and their current stock chart looks awfully similar to how it did right before that early 2000s crash.
Part 3. The AI supply shock. Repeating the cycle. 3 different centuries, 3 different industries, all playing out the exact same cycle. Let's pull this historical lens directly onto today's AI market.
Data from Harvard economist Jason Furman reveals something genuinely staggering. When the railway or fiber bubbles popped, they took down some investors in specific sectors. But AI is different. AI is quietly holding up our entire economy. The AI build-out, information processing equipment and software, is only about 4% of total U.S. GDP. Yet, incredibly, it accounts for roughly 92% of all U.S. economic growth right now. If you strip AI out of the equation, the U.S. economy practically flatlines. We are all clinging to this one massive, highly concentrated bet.
So where exactly are we in the cycle? While the flood of money is definitely still pouring in, but the cracks, they are starting to show. Remember how I said demand can be faked? In the 90s, the telecom industry faked demand with this totally made-up narrative about internet traffic doubling. Today, they're faking it with money. Look at this circular financing loop. NVIDIA funds OpenAI. OpenAI uses that money to pay Oracle for cloud services. Oracle then takes that same money and buys more NVIDIA chips. The money makes a complete circle, but every time it changes hands, it gets booked on paper as new demand. It's the exact same vendor financing trick telecom companies used in the 90s to manufacture the illusion of demand until the credit just dried up. The absolute best place to look for those returns slipping is right in the eye of the storm. OpenAI. 2 years ago, ChatGPT had basically zero real competition. But now, we are deep in a crowded boom phase. You've got Google, Anthropic, Meta, and a dozen others all selling essentially the exact same product. When OpenAI's financials recently leaked, we saw the true cost of this boom phase, a massive, jaw-dropping projected 2025 loss of $38.5 billion. That is nearly 8 times their loss from the year prior. And even wilder, $5.7 billion of that was spent solely on sales and marketing just to stop users from jumping ship to competitors. The returns are literally being crushed by the massive new supply.
And because those returns are slipping, the overall market has become incredibly fragile. Take the chipmaker Broadcom, for example. Recently, they actually beat their current earnings expectations, but they guided their future AI sales just a tiny bit light. Just a minor, routine miss. The result? Roughly $300 billion of market value simply vanished in a single trading session. Poof, gone. When a rounding error in guidance erases $250 billion in a day, you are not looking at a healthy market. You are looking at a market priced for absolute perfection, ready to fracture at the slightest hint of disappointment.
Part 4. Pioneers versus settlers. Who claims the prize? We've seen the flood, we are deep in the boom, and the collapse is the next mathematical step. So let's talk about who actually survives this.
There is an old classic rule in business. The pioneers get the arrows, and the settlers get the land. The pioneers, companies like AltaVista in search or Sidecar in rideshare, they rush in first. They take on massive risks, they bleed cash fighting all the legal battles, they build the unbelievably costly infrastructure, and then they go bankrupt. They take the arrows. But the settlers, think Google and Uber. They walk in later as the dust settles. They don't repeat those costly mistakes. They swoop in, inherit the amazing foundation that the pioneers bankrupted themselves to build, buy it for pennies on the dollar, and then they build empires.
And that really brings us to the core takeaway of this entire explainer. The whole internet is having the wrong fight right now. Screaming at each other about whether AI is a bubble or a breakthrough is completely missing the point. The breakthrough is real, but the undeniable mechanics of the capital cycle guarantee that a massive wave of supply will ultimately crush those initial returns. We have to stop watching the noisy demand side that the media is so obsessed with and start focusing on the quiet mechanics of supply. Because when this cycle inevitably turns, the only question that will actually matter is this: who floods in, who drowns in their own supply, and who walks in to inherit the future for pennies?